It's investment. That's what we're doing this evening with Maya Fisher-French. Maya on Money is her website. She is a prolific communicator on personal finance, an award-winning personal finance journalist, and our emotions. Oh, we do love our emotions, Maya. Our emotions cause us to do stupid things, sometimes do nothing. Often we get ahead of ourselves. I don't know where we should start on this, but maybe something called the behavior gap. Is that a good place to start?
Bruce, I think behavior gap's a great place to start, because it was a concept I think was coined by Carl Richards. He's an American sort of money guru. And he used that to describe the difference between the performance of a fund and the returns we actually get from the fund because of our investment behavior, which usually involves switching out at the wrong time. And Momentum Investments actually recently did a lot of research around this, especially over COVID and that sort of thing. And it was headed up by Paul Nixon, who's head of their behavioral finance. And they've coined it a behavior tax, which I quite like, because, this idea that our behavior is costing us money, I think is quite a good concept. So when they analyzed it, they looked at March 2020, that famous day when the market, famous month when the markets crashed, and obviously everybody was pulling all their money out. They panicked, and then the investors, within 3 months, the market bounced back, and you couldn't get in fast enough, right? It was like this complete and utter, re-rating of the market. It flew, it jumped back up again. And they analyzed their funds over that period, and they estimate that about 650 million rand in investment value was destroyed, what they call behavior tax, because people were buying high and then selling low. And they calculated this behavior tax as shaving off about 6.5% off those investors' investment returns that year. And again, in 2021, that figure was about 3.5%. So again, investors got out about 3.5% less than they would have if they just stayed the course. And Bruce, if you think about 3.5% and you compound that every year, it starts to have some big impacts. And I was reminded about some research actually that Alan Gray did, very similar research. But Alan Gray's was over 10 years, and I think they published their results in about 2012. And they found over 10 years, they analyzed the Alan Gray Balanced Fund, and they worked out that the fund had returned 16.6% over that period per annum, but the average annual return by the investors in the fund was 14.3%. and that's not because of fees. And that was literally because of switching. And, if you compound that difference, I did a compound comparison.
This is important, Maya. Just pause there for a moment, because people go, well, okay, so people panic a bit. It's only 14.6 versus 14.3 versus 16.6. It's 2.3%. What's the big deal? But you use that important word of compounding. And again, the concept of compounding is the most important lesson to learn in the world of investments. It is the one thing that makes great investors versus people who do okay versus people who fail.
Absolutely. And you look at that compounding effect of switching, and I worked out that, what is that difference of that 2.3%, Bruce? And over a 10-year period, if you put in 100,000 Rand, you'd stuck it out and you hadn't tried to switch and be clever, you would have had 520,000 Rand at the end. But the average investor only got out 414,000, so about 100,000 Rand less. 100,000 Rand, that is the behavior tax. So absolutely, Bruce, this constant behavior is the problem. If you do it once, you learn your lesson, but it's this constantly thinking that you can time the market. It's a big issue.
And it's not even thinking you can time the market. I mean, some people think they can time the market, but mostly it's just people getting really nervous and getting really panicky and getting really twitchy about their investments. And you tend to be going, oh, look, I'm a genius. Look how clever I am. Look how wonderful I am. Oh, my goodness me, the market's fallen 20%. I better get out now. And then you panic at 25%, and then it turns at 30%. And then when it's up about 25% again, you think, oh, I better get back in again, because otherwise this thing's going to run away with me. And you've lost money on the downside. You haven't got in on time on the upside, and you just end up hurting yourself in the process.
Absolutely, it becomes even a bigger mess, and that's exactly the point of the emotions, right? This is all about our emotions. So there's this concept of perceived risk versus real risk, and our perceived risk is really what leads to this behavior attacks. And I mean, Bruce, as you point out, when we panic, something actually happens in our body. It's a physical reaction. We have this massive flood of cortisol. It's released, and we get into this fight or flight mode, and we panic. And, we sell out. And perceived risk the reason perceived risk is so dangerous is because it is influenced by recent factors. So even take a bull market, right? A positive market. This market is running, and we now are comfortable. We think the risks are low. We think, oh, there's no risk because it's going up and it's going up. And so we invest when actually the risks are building, because possibly a bubble's building. The more expensive the asset becomes, obviously, the more chance that it'll fall again. So we actually completely and utterly miscalculate risk. And then obviously the opposite happens when the market crashes. We start to panic, or when the market is down and not going anywhere, we don't want to invest because of the sense of, if something's doing badly, it's high risk. If something's doing well, it's low risk. We completely misaligned on what risk really means. And I think, Bruce, the point you made as well, I don't even call it fear and greed. I think it's more comfort. We want to do what everyone else is doing. It's very, very hard to go against what everyone else is doing, the herd.
It most certainly is. And so this momentum research you referred to, and Paul Nixon, who's very good at this behavioral economic stuff, it talks about the important risks. And so often we just see all risk as the same. But unfortunately, not all risk is equal, right?
No, some risk needs more attention. And he talks about that there are risks that we're not focusing on. And I was reminded about Freakonomics. I'm sure you've read the book.
Yes.
Freakonomics was written 10 years ago, whatever it
More.
was.
No, it's about at least 15. It's great.
No, at least 15. I'm showing, I promise you, time is just a blur now.
Flying.
You go back and anyway, so however many years ago it was written, I still clearly remember the chapter where where they wrote that swimming pools kill more people than guns. Now, I'm not saying that we shouldn't worry about the risk of guns, but we probably don't worry enough about the risk of swimming pools. And I think that's the sort of concept. It's those things we're not worrying about. And as exactly as you're saying, what Paul's identified is he said, the risks that we should be focused on are the risks I can afford to take and the risk I need to take. So the risk you can afford to take really talks about making sure you have liquidity. The good old emergency fund that we always talk about, land up somehow, Bruce, talking about, because I love emergency funds. But, if you take all your money and you go and put it in a really high equity fund and you've got no liquidity and something happens, you're going to almost be forced into a behavior tax if you're forced to sell at the wrong time. You're having to cash out. So it's really important that you have some liquidity so that you can take life's ups and downs and leave your money to grow. And then the opposite is true as well, where you're taking really excessive risk. Maybe you're taking money, I know people who've taken their pension funds and done crypto punts. You can't afford to take those risks. No one can afford to take that kind of risk. No one can afford to put all their money into a single asset. So that's really the risk you can afford to take. What is my sensitivity to this if I needed the money or if I had to sell out? And then the other one he talks about is the risk we need to take. And I think, Bruce, that's the one most people also just don't realize, is you have to take some risk to achieve your goals. You can't be sitting with your money in cash or under your mattress forever, because you're not going to get a retirement income. And in this case, too little risk is actually the real risk, when you're just simply not keeping up with the cost of living.
Maya Fisher-French is our guest this evening. She is the publisher and owner of Maya on Money. She is a celebrated personal finance journalist, and we're going to talk about that risk that you need to take, your risk tolerance, and how you determine what that risk tolerance is. Because we all think that we're risk averse. I think we think that. Of course I can take risk. And, while markets are going up, geez, this risk thing is fantastic. Look at me. I'm a genius. Until the market then turns on you and you've made 20% over the last year, but you're down 5% and markets are falling on a daily basis, and suddenly you're going, I'm losing all my money. And you panic. What is your risk tolerance and how do you measure it? And then how do you manage it? More importantly, in a moment.
The Money Show. Investment School.
With Maya Fisher-French in a moment. The Money Show is brought to you by ABSA CIB, supercharging Africa's sustainable energy future and collaborating with their clients at the 2023 Africa Energy Forum to enable the continent's renewable energy transition. ABSA is a registered FSP. Let's talk about how you measure your risk tolerance. We have risk perception and then we have risk tolerance. One is what we dream about and we think ourselves as super brave, super athletic, super magnificent, flexible and everything else. And when it comes down to when the rubber hits the road or the losses hit the back pocket, our risk tolerance is then tested. And that's not, that's a real thing, isn't it?
Absolutely. I would say sort of, risk tolerance is your personality. It's actually in your DNA. How are you going to respond to risk? And Paul Nix actually created a questionnaire, a money fingerprint questionnaire, which assesses your money personality. And Bruce, I completed it. It was very interesting. I must tell you, gave me quite some insights into my money perspectives. But coming out of this, you get different types of people, and there are risk takers, and there are people who are really, really anxious about money. And what I found quite interesting is that in this analysis that they did over 2020 and 2021, and 22 actually, looking at this behavior tax, they found that assertive investors, so very confident investors, incurred a very high behavior tax of about 4.5% per switch during 2022, which was actually not a bad, for most people, it wasn't a bad behavior tax year. So, in many regards, having overconfidence or is actually, it can actually be a problem. But then people who are money anxious, and that's where this risk tolerance becomes a problem. If you have to take a certain amount of risk to achieve your investment outcomes, to achieve your retirement, a lot of people are not comfortable with the idea that they can lose money. And that's when that sort of risk tolerance, their just gut sort of personality fear, can be in conflict with the risks they actually need to take. And I think one of the factors that can really improve this is financial knowledge, Bruce, which is why you do shows like this every week. Because what I found very interesting is my personality is actually money anxious. I worry about money and I worry about my future. But because I have good investment knowledge, I'm comfortable to take the risks I need to take in order to get my money to grow. So I think that is one of those things that you need to be doing, is to understand investing, because you can't just say, I'm scared of this, I'm going to stick my money in the mattress, because you're not going to be able to get where you need to be in order to have, in this particular case, say a comfortable retirement.
And it's so important to understand that you can be apprehensive about investing, but if you understand it, like most things, I suppose, facing any sort of challenge, if you understand the magnitude of the challenge, you understand the risks and the opportunities associated with the challenge, whether it be a long hike or whatever it might be, once you understand the mechanics of it just a little bit, you can then say, right, actually, I can manage this. I am capable of managing it, but you can't go into this thing blindfolded. You can't go in there going, I'm just going to throw some money into an investment and see what happens, because that way you've not considered it, you've not thought about it, you've not tested your risk tolerance, and you are going to panic at a moment's notice.
Absolutely, and you're most likely going to have a negative outcome as a result of that. So I've come across many people who say, I'll never invest in the markets again because I did once and I lost money. But when you go and ask them about when they invested, it was invariably when the headlines were talking about new records being broken on the market. And of course, Bitcoin would be a very, very classic example of that, of people running in right at the peak, then losing money and saying, you see, I was right. You should never invest in anything. I'm going to keep my money in cash where I understand. And I think if you are the sort of person who gets anxious and you're not going to sleep at night, you need to have an investment plan that smooths out some of these rides. And Bruce, you can't get better than rand cost averaging. So, that's rand cost averaging when you put money in every month on a regular basis and you just leave it to grow. Because if you understand that when the markets fall, you're actually making money because you're buying more shares for the same amount of money is buying you more shares when markets fall, and it's actually boosting your return. So I think even something as simple as explaining rand cost averaging and getting someone just to commit to a monthly debit order, investing, you can overcome some of those really big fears. And I think another thing is having a plan of what happens, and this comes back to one of the earlier points I made, what risk can you afford to take? So, for some people, in order to be comfortable, they will need more sitting in cash. Maybe they are investing in the markets and they're doing the right thing, but if the markets crash and it's 5 years to recover, how does that look for your financial plan? And you can say, well, I've got enough cash, more liquidity, less risky assets that I could rely on. You've got to make sure that you have these plans in place and that you're able to go back to those when the panic sets in, because that cortisol is going to be flying through your system. You're going to be listening to Bruce on the radio talking about the market crash, did this, and you're going to say, it's okay, I have a plan. I had a plan if this had to happen. And the plan usually starts, Bruce, with doing nothing. Sit on your hands and breathe and just wait. That's usually how it starts.
And it's so hard to do, and that's why when people ever approach me about this and say, how do you stop panicking? And it's a case of pick a time frame and try go back as long as you can, a time frame of 10 years. And just call up a graph. They're free all over the internet. Find some credible graphs, and you will see a graph that generally starts in the bottom left-hand corner, and with a lot of seesawing and ups and downs, but a general upward trend with a couple of horrible shocks in between. Generally, you start seeing a market that starts moving towards the top right-hand corner at some point. And the last 10 years haven't been great for investors on the JSE, but they've been pretty good, in terms of, for all of the noise and negativity in our environment, surprisingly good. Actually, in terms of investment returns, not as good as the S&P 500, not as good as the Nasdaq has been, not as good as other stock markets have been, but not catastrophically awful in the way that people assume investment markets have gone, because they look at their daily reality, they look at the mess and the chaos and the noise and the load shedding and the potholes, and they think that stock markets do the same thing, and they simply don't.
And I think, Bruce, it comes down to understanding, again, what are you investing in? Do you still go shopping at Pick and Pay? Do you still do all of those things? That is how companies make money. And I think there's this misconception that that the stock market in and of itself is the investment, if that makes sense. So it goes up and it goes down. It isn't. There are companies you're investing in. It's those companies that are making profits, that are, providing dividends, that are growing. That's actually the investment. And of course, Bruce, the best way to help yourself sleep at night is diversification. So you should be having some offshore investments, and have yourself spread geographically as well, which also helps you sleep well at night. But I think that's absolutely true. You've got to just, listen, don't get caught up in the noise.
I'm just going to put in cash, Maya. I'm going to put it in cash. I'm looking at a graph. It's published on the Investec website. I just called up stock markets, and it goes back to 2009. It's published by Brian Cantor. And he's got 5 investment classes. CPI, which if you go back to 2009, inflation has gone from 100 to 164, and all investments have outperformed inflation. Emerging markets are 187. The JSE is not great. It's 276. So if you put 100 Rand into the market in 2009, it's worth 276 Rand today, despite all of the stuff that's happened in between. If you'd put it into the S&P 500 in Rand terms, that 100 Rand became 680 Rand. That doesn't necessarily mean that 680 Rand goes up to 40,000 Rand over the next 15 years, but certainly it gives you an indication of long-term investment cycles. Maya Fisher-French, thank you. Maya Fisher-French, the founder, the editor, the publisher, the chief cook and bottle washer at Maya on Money.